We're closing in on the next FOMC meeting, and this one is likely to be a very, very important one. Maybe even more so than the last ones, which I do know I also said were very important, and they all are. But what are the Federal Reserve likely to do in this next meeting? So the US appears to be on the other side of the pandemic now. Economic growth is relatively good, and inflation is well above the Federal Reserve's target. Something that might not be so great right now are some of the low labour market numbers we've seen in recent months, but if we look at the average number of jobs added this year, it's actually not too bad. So this all raises the question of whether quantitative easing, QE, is still needed or not. And based on comments from Fed policymakers, the consensus is quickly changing towards not needing it. All the signals are pointing towards there being a very real chance that the Fed will announce scaling back on their QE this year, either in the November meeting or the December one, along with outlining a timeline for tapering it down to zero. Inflation has been running high recently, and that's becoming more and more of a concern. By tapering back quantitative easing, the expectation is that this would reduce aggregate demand in the economy and therefore help bring inflation back towards the Fed's 2% target. However, reducing demand can also harm economic growth. So the hope would be that the recovery would remain strong enough that economic growth would continue and the labour market would keep recovering. But tapering is obviously not an instant process, hence the term tapering. So it's not like they're going to just slam on the brakes immediately. Doing that would be terrible for the economy. Instead, scaling back will happen over a number of months, and the Fed has already signalled that they're looking to reduce purchases at a gradual pace until probably the middle of next year. So if something does go wrong during that time, the Fed will be keeping their options open and could extend the timeline if needed. At the moment, we expect that the Fed will hold off on raising rates until after tapering is complete, but things could change, as we've already seen recently with the Bank of England seemingly changing their sentiment about rates. So if inflation did start shooting up or tapering wasn't having the desired effect, then they may be forced into taking even more drastic moves, but right now that's not looking very likely. Ever since tapering became the focus a number of months ago, there have been concerns that there could be a replay of the 2013 taper tantrum. However, so far it seems that the Federal Reserve has managed to avoid a tantrum, at least so far this time around, and they're also very aware and cautious about it, and they don't want to be causing those sorts of effects in the markets. So they seem to be at least signposting a lot more for the market. But US equities do sit at all-time highs, at least at the time of filming this video, and this is in no small part because of stimulus like the Fed's QE. So pull that easy money away, and what's going to happen to stocks? Well, you'd imagine that a correction of some sort is fairly likely. So far though, despite the market knowing that tightening is on the horizon, it doesn't seem to be too shaky just yet. And in fact, any downside may be offset to a certain extent by rises in company earnings, as we saw in the last couple of quarters, as the economy returns more and more to normal, and hopefully in the near future, supply chain issues begin to ease up as well. But if bond prices also decline as demand from the Fed falls, then this would increase the yield and some investors may move money from equities into bonds as they become more attractive. Typically, tapering would also be bullish for the US dollar, and the dollar index has been pretty bullish since June this year, so this would make US equities more expensive for foreign investors and can impact company earnings as US goods and services become more expensive compared to global competitors. But overall, expectations of tapering have been pretty clear, and it seems that the markets will remain relatively steady during this time. There's likely to be some movement when the announcement's made, but the focus will probably start to shift instead towards those rate rises that are likely to come in the future. And remember, although you can never count on things playing out 100% the same way as previous times and as what history shows us, we do now have a precedent that we can study since we've only been through this a few years ago. So unlike the 2013 taper tantrum when there was little to compare the situation to, I think this time around we can benefit by looking at which markets were impacted and how they were impacted when the Fed took similar actions to this before. So hit the like button if you found this useful or interesting, and let me know your thoughts in the comment section below. Thanks for watching. See you in the next one.